Peter Thiel warned bank run will spread. As a systemic liquidity crisis is lurking, take your money and run now. And it's gone. Silicon Valley Bank grew too fast using borrow money, and the risks were lurking in plain sight. What caused the bank run? Why SVB's failure is just the beginning. When you raise interest rates quickly, after 15 years of overstimulating the economy with near zero interest rates, to not imagine that there is not leverage in Silicon Valley that will be stressed is naive fantasy. Why Peter Thiel warned his investors that failure of SVB is just the beginning. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back, everyone, to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore, you want it to be real, you want it to be true, you want to be my client, don't you? Silicon Valley Bank's failure boils down to a simple misstep. It grew too fast using borrowed short-term money from depositors who could ask to be repaid at any time, and invested it in long-term treasury bonds that it was unable or unwilling to sell. When interest rates rose quickly, it was saddled with losses that ultimately forced it to try to raise fresh capital, spooking depositors who yanked their funds in 2 days. The question following the bank's takeover Friday: how could regulators have allowed it to grow so quickly and take on so much interest rate risk? And it wasn't the only problem bank last week. Just days before, SVB stock down 60.41% in a day, collapsed more in aftermarket. Silvergate Capital Corp, one of the crypto industry's biggest banks, said it would shut down too. When a bank takes on your deposit, a liability to the bank, they have to switch that with an interest generating asset, which is a U.S. Treasury securities or mortgage-backed securities. The aftermath of these two cases is evidence of a significant supervisory problem. That's why we have fleets of bank examiners, and that's what they're supposed to be doing. The Federal Reserve was the primary federal regulator for both banks. Notably, the risks at the two firms were lurking in plain sight. A rapid rise in assets and deposits was recorded on their balance sheets, and mounting losses on bond holdings were evident in notes to their financial statements. SVB grew at a breakneck pace, nearly doubling deposits in just a year. Total assets at its parent, SVB Financial Group, grew to $211 billion. at the end of 2021 versus $116 billion a year earlier. By the end of 2022, SVB was the 16th largest lender in the US. Its implosion was the second biggest bank failure in American history and marks the biggest test to date of the post-financial crisis regulatory architecture designed to force banks to curtail risk and monitor it more closely. Rapid growth should always be at least a yellow flag for supervisors, said Daniel Tarullo, a former Federal Reserve governor who was the central bank's point person on regulation following a financial crisis. That's because risk controls and buffers against potential losses often don't grow in line with new risks being taken by fast-growing banks. In addition, nearly 90% of SVB's deposits were uninsured, making them more prone to flight in times of trouble since the Federal Deposit Insurance Corp doesn't stand behind them. A $200 billion bank should not fail because of liquidity. They should have known their portfolio was heavily weighted toward venture capital. And venture capital firms don't want to be taking risks with their deposits. So there was a good chance if venture capital portfolio companies started pulling out funds, they'd do it en masse. When money was pulled out from SVB, and their treasury bonds are upside down because deposit is going down. That means they need to bring their assets down. So they were forced to sell their treasury notes or bonds like TLT and record a loss on their book. To recapture their loss, they sold more than $2 billion of shares of their stock to raise cash, which caused the stock crashed 85% in 2 days. SVB and Silvergate both had less onerous liquidity rules than the biggest banks. In the wake of failures, regulators may take a fresh look at liquidity rules, with an eye toward adjusting the requirements for holding high-quality liquid assets for banks whose funding sources go far beyond retail deposits. Federal Reserve, the banking regulators, who is supposed to be out there protecting the banks and people's money, providing regulations to make sure the system is stable, gives people confidence to deposit their money in the bank. And yet, they are the ones destabilizing the entire banking system right now. The Fed is not your friend. Also, you don't want to fight them. To be sure, banks regularly borrow short-term to lend for longer periods of time. But SVB concentrated its balance sheet in long-dated assets, essentially reaching for yield to bolster results at the worst possible time, just ahead of the Federal Reserve's rate hiking campaign. That left it sitting on big unrealized losses, making it more susceptible to customers pulling funds. Regulators were aware that the unrealized losses in banks' securities portfolios could lead to trouble, but didn't take specific steps to address the issue. This is something that's been rolling through the industry for several months. They did nothing to help this bank, referring to SVB. Indeed, the two firms aren't the only ones facing the risk posed by unrealized losses. The banking industry as a whole had some $620 billion in unrealized losses on securities at the end of last year, according to the Federal Deposit Insurance Corp, which began highlighting those late last year. Another regulatory issue: accounting and capital rules that allow banks to ignore mark-to-market losses on some securities if they intend to hold them to maturity. At SVB, the bucket holding these securities, consisting largely of mortgage bonds issued by government sponsored entities, is where the biggest capital hole is. The idea behind such a bucket is that it insulates an institution from short-term price volatility. The problem this poses is twofold. First, a bank may not be able to hold such securities to maturity if it faces a cash crunch, as happened at SVB. Yet selling the securities would force the bank to recognize potentially massive losses. Second, the treatment of the securities means banks like SVB are discouraged from selling when losses emerge, potentially causing problems to fester and grow. That appears to have been the case at SVB and many other banks, as rising interest rates in 2022 caused large losses in bond markets. Banks have an additional incentive to pile into treasuries. They have to hold less capital against such holdings, supposedly because they are risk-free. However, this means banks are holding less capital to absorb losses, and treasuries can't lose value due to changes in interest rates. Others said monetary policy over the past decade played a role. The Fed suppressed the yield curve and made it very clear to the banking industry that you would do this for a considerable period. So bankers are making decisions based on that message and based on that policy. And they fill their portfolio up with government securities of varying maturities. And they say they're going to hold them to maturity. Silvergate and SVB may have been particularly susceptible to the change in economic conditions because they concentrated their businesses in boom-bust sectors, with companies in those sectors now moving assets elsewhere in the financial system. The nature of those risks may shift. When the Fed jacks up rates 500 basis points in a matter of months, you expect SVB happen. But no one was talking about it before it happened. People often need to see it to believe it. So if you know how yield curve can predict recession and has been predicting it 100% of the time, that's why TLT is going higher now. What does Silicon Valley's bank's failure mean? SVB from $275 million in net income to bankrupt in a quarter. It's impressive. It means when people see the truth in plain sight, changes can happen. Also, startups can't make payroll in this recession. And my client's collaboration book, it's already yours, Adversity Equals Success. Such an amazing book with such incredible stories. Order your copy today. And my book, Rainbow Focus. You are such a good boy for watching my video right till the end. Bye.